Well, good afternoon, everybody. I'm Ric Edelman. Thanks so much for joining us on this program today in the middle of this holiday season. Happy holidays to everybody. We have been going through a tumultuous year in so many areas. I don't need to tell you what that is all about. We all know too well, and everything that is going on at the moment on a global economic as well as geopolitical environment. But one of the things that's been happening below the radar a little bit because our attentions have been focused elsewhere is what's happening in the world of crypto. We've been in a so-called crypto winter for years now, two and counting, where we saw Bitcoin hit a high of $60,000 and a low of 15,000, a 70% deduction in the price of Bitcoin. And it's raising the question because Bitcoin is up 150% year to date here in 2023, is the crypto winter over? We're going to answer this question for you and help you figure out what's coming next in the world of crypto. And should you pay any attention to this? Should you engage? And if so, how and how much, and how best to do this on behalf of your clients? So I'm really happy to bring onto the program two folks who really know what they're talking about in the world of crypto, Erik Anderson and Andy Baehr. Gentlemen, good to have you both with us. For those of you unfamiliar, Erik has been focusing on the cryptocurrency space for a very long time, and he is in fact the senior digital assets researcher at Global X ETFs, one of the largest and oldest thematic ETF providers in the country, with a big focus on crypto. And Andy Baehr, who is managing director of CoinDesk Indices. Great to have both of you with us today.
Thanks for having us, Ric.
Thank you, Ric.
So, Erik, do us all a favor here as we begin and launch this, and talk a little bit about Global X. It's not the household name that some other ETF providers are, but what you folks do, I think, is rather unique. So take a moment and tell us about Global X.
Yeah, I would love to. Thank you. So Global X is as the name would suggest, we're a global issuer of ETF products. And we currently manage over $40 billion of assets. Many of you might know us for our leadership in the thematic investing landscape. We offer dozens of investment products that really allow our clients to be able to access more tailored exposures to innovations and disruptive themes that we believe stand to change the world as we know it going forward. So, of course, themes like AI, infrastructure, robotics really fit squarely into this thematic suite of products. But also, we're really proud to be a leading issuer of regulated products in the digital assets realm as well, which is part of my job to support as the head of our research team. Now, beyond thematic investing, we also offer products across a robust suite of income strategies as well, including covered call strategies, as well as some dividend strategies and some others, as well as a suite of international access ETFs, providing exposure to the stock markets of one-off countries. So we have offices in New York, London, South America, Asia, Australia, all around the world. And we're really just pride ourselves on being able to provide really high quality service and really interesting investment products to our clients.
And when you need to, you're not afraid to partner with others, which is the relationship you have with CoinDesk. Andy, CoinDesk is one of the biggest, most I'd say prestigious firms in the crypto environment. But if you're not really immersed in the world of crypto, it's not a household name. So tell us about CoinDesk.
That's a warm intro, Ric. Thank you. CoinDesk is a strong name in media, a strong name in events, and a very well used and very well regarded name in indices. The CoinDesk media name is the most trusted voice in digital assets and is just marked its 10th year of existence. Consensus, our main event and the supporting events are really the gathering place for all things digital assets and Web3. And CoinDesk Indices is the leading provider of digital asset indices by AUM, and we're going on our 10th year this year. We power the largest digital asset investment products, everything from single token prices. There's not just one exchange for digital assets. So in order to really come up with a true price, you have to index that process, and you have to deliver that to managers and other product providers. We have a large taxonomy of 500 tokens called DAX, which supports all of our multi-asset, broad market, and sector indices. And in the past year and a half, we've started to get into strategies as well. And that's one of the things we're going to highlight today and forms part of the basis of our collaboration with Global X, which is really exciting, which I would argue is a household name. And so we'll talk a little bit about that as well. But really delighted to be here and talk about these markets.
Well, I'm really excited about this conversation, if only as selfishly because of the fact that I, like everybody else in the crypto world, have been struggling through the crypto winter for the past couple of years. Those of us, Andy, like you and me, who've been involved in this space since 2012 or so, have gotten a little some calluses. You know, we've been through this many times. This one was a prolonged one and a deep one, but not the first time. And everybody's wondering, is the crypto winter over? So I'm going to pose the very first question to you, Andy, and I'm going to force you, I'm really going to impose this on you, that you do what nobody in the financial services industry ever wants to do, which is to give a one-word answer. So I'm going to point it to you, yes or no, and put you on the spot. Is the crypto winter over?
The most recent crypto winter is definitely over. I'm going to say yes strongly. It's funny. It's interesting that this is a December conversation. I remember doing a spot on CoinDesk just a little bit less than a year ago when Bitcoin was at 15,000. And, you know, people gather around the holiday family table. And at that point, if you had been the one talking about digital assets for the last couple of years, you know, you kind of sidled up to that table sheepishly and had to defend and had to say, don't worry, it's not over yet. But things looked pretty bleak. I'd say that, you know, by sense of the news cycle, the economic cycle, the macro cycle, and just I guess the stage of life of this new emerging asset class, the most recent winter is definitely over.
And so I'm going to now ask you, and this is where you'll really have a chance to chime in a little bit better, and I think more meaningfully for the advisors who are watching us. And oh, by the way, if you have your questions, many of you did send in questions when you registered for this webinar, and I'll get to those questions with Erik and Andy as we carry on our conversation today. But if anything pops into your head, just go to the Q&A box here on the Zoom link and type in your question, and we'll tackle as many of them as possible. I'll be checking that Q&A box as we go on. Okay, the crypto winter is over. Erik, I'm assuming you agree with that statement as well?
Definitely. I mean, do I think we're going to all-time highs in the next 3 months? No. Do I think that we're much closer to the end than we are to the beginning? Absolutely. I think that the market prices tell that out. I think a lot of on-chain metrics tell that same story as well. So I'm firmly in the camp that we are on the other side of the hill right now.
So if the three of us are in agreement to that fact, that the crypto winter is over and we are now thawing, if we haven't fully thawed from the ice age, and we are emerging into the crypto spring, hopefully launching into a crypto summer, which may, by the way, coincide with the actual calendar this time around. What does it mean? I mean, okay, the crypto winter's over, but so what? What does that really mean for financial advisors and their clients? Is that elimination of the crypto winter translate into higher prices? And if so, how high and by when? We already got a tease from Erik on this. Andy, give us your thoughts.
You know, when it comes to an advisor conversation, I like to think of the last mile being a very important concept for adoption. I've seen some statistics that 50 million Americans have some form of digital asset exposure, but for most, it's a hobby, right? They might have an account with a native digital asset exchange or a cold storage device at home. I would think it's fair to say that most of those 50 million haven't integrated digital assets into their bigger, more broad financial picture. And part of that's their responsibility to think about that, but it's also the industry's responsibility to pave that last mile. Think about things like buying a house or buying healthcare or any other kind of financial service. The last mile delivery process is one that's trusted. And that's a lot of where the trust goes into somebody making a larger commitment. I may, as an early adopter to electric vehicles, wander into a Tesla store and spec out a Tesla and buy it. But if I'm really kind of a Ford person, I'm going to wait until the F-150 Lightning comes to my trusted Ford dealer, and then I'm going to feel more comfortable about making that purchase. So for advisors, the key is, have they been given the tools that they need to integrate digital assets into a larger conversation with their clients about portfolio construction, about retirement, about asset allocation, and about all the benefits that digital assets and Bitcoin in particular have. So one of the things that generates some strength in my answer that the crypto winter is over, particularly in the United States, is that we're starting to see the ways that that last mile can be paved with very familiar instruments delivered by very trusted people. So for advisors, it's going to mean they have more information, they have more support, they have more educational support, they'll have more administrative support. They'll find it easier to make a prudent allocation into digital assets into their clients' portfolios.
Yeah, and I would add to that, all of what you just said, is the fact that it's been a heavy lift for advisors over the past decade with the emergence of Bitcoin back in 2009 to add it to a portfolio. It was cumbersome, it's complicated, it didn't easily fit into the advisor's tech stack. It forced them to retrain their staff, it forced them to reculturalize their clients using not only a product that's new to them, Bitcoin, but exchanges that were also new to them from players they'd never heard of and didn't know anything about. And it was also very difficult with many of these services to have the advisor easily rebalance the portfolio, to easily integrate it with the rest of the allocation, to frankly debit their fee. Let's face it, that's something that's pretty important to a lot of advisors. And so it seems like the crypto industry worked really hard to make life really difficult for advisors. And so even if the advisor wanted to engage, let's face it, most of them didn't, there wasn't an easy path. So I appreciate your reference to the last mile, because that is really the key, I think, descriptor, that the crypto industry has grown up a lot in the last few years, not least of which I think because a lot of financial services industry executives have gotten involved. A lot of former Wall Streeters are now in the crypto community. A lot of former regulators are in the crypto community. And we're providing what I like to think is adult supervision in the room. You know, the crypto bros were great. They were fun and they were, cool at what they did, but they didn't understand the financial services industry. They didn't understand the broader investing marketplace or the consumers in this country. And I think that they succeeded in getting 5% of the country to pay attention, but they're never going to get the other 95%. And we're now discovering products and services from really serious, well-known brands that understand customer service and advisor relationships. And I think you're absolutely right. That's a big driver. Are you seeing that, Erik, at Global X? Are you finding advisors, as a result of everything we've just described, more willing to engage in conversation about all this?
I think that for me, the thing that's made the most interesting, poignant shift in the conversation really has to do with just the institutional backing of crypto-related products now. So you have a slew of spot Bitcoin ETFs in active applications with the SEC, the potential for that on the Ethereum side. We already have actively traded futures-based products for these assets. And I think what was a huge barrier for a lot of advisors, and rightfully so, prior to the launch of more of these regulated products, was just the question of, if I put this into a client's portfolio, is it going to be around in 5 years or 10 years? I mean, there's a huge amount of career risk that comes with that. I think now that you're seeing more of this institutional backing, Larry Fink being on CNBC talking about Bitcoin being a potential flight to safety or flight to quality, that provides a lot of, it provides a lot of comfort to people who are, at the end of the day, going to have to answer to their client with Bitcoin either up 70% or down 70%, why they put that in the portfolio. So we're seeing a lot of that at Global X as well. As you've had kind of that more, you've added that kind of layer of credibility to the asset class. It's been around for 10 plus years. More and more institutions are backing it. Clients are getting a lot more comfortable coming to us with questions, trying to level up their education, because at the end of the day, that's what's going to be required of them, of their clients who are younger and who at this point do tend to hold digital assets in greater quantities.
And that all makes perfect sense. I mean, as an advisor, I can certainly understand the attitude of other advisors who say, look, You mention all these names: Multicoin, Pantera, Galaxy. Never heard of any of these guys. Who are they? Well, these are some of the biggest crypto fund managers in the industry. Nobody's ever heard of them. But then suddenly we say BlackRock, Fidelity, Invesco, Global X, Franklin Templeton. And all of a sudden we're like, wow, these are the biggest, most established brand names in the financial industry on the planet. And as you pointed out, when people like Larry Fink go public with a statement that this is going to transform global commerce, it allows people to stand up and say, yeah, now I have some confidence. Now I can rely that these folks are not going to risk their brands on this allocation, and it gives me a higher degree of confidence. But until that happened, and that's relatively recent, it was easy for an advisor to say, I don't know who these other companies are. I don't know if I can trust them. With all the frauds and the scandals and the controversies of the last decade, since I was only going to do a low single-digit allocation anyway, why do I want to risk my reputation and my AUM on something that may or may not work with people I may or may not know? And so I can understand why an advisor would have sat on the sidelines. It pains me to say that because like you, Andy, I've been promoting crypto for over a decade. I created DAC-FP way back in 2015. And ever since 2013, I've been touting on my radio show and everywhere else that you need to allocate to Bitcoin. You need to own it. I was saying this when Bitcoin was $1,000. I was saying it when Bitcoin was $3,000. And the overwhelming majority of people ignored me for the reasons I just cited. They didn't want to take the risk with something unknown and uncertain. I get it. That's okay. But now fast forward, here we are. And advisors are now willing to pay attention. They're willing to learn more. They're more open to the conversation. Their clients are as well. The level of crypto curiosity is at a high. Mm-hmm. But it raises the related question, is it too late? Bitcoin is no longer $3,000. It's not even $33,000. It's now $42,000 as of today when we record this. It hit $44,000 just a couple of days ago. Is it too late? In other words, what do you see going forward for the prices of Bitcoin in particular and crypto broadly in 2024 and beyond? Andy, I'll start with you.
Yeah, and thanks. Just to rewind a little bit. Well, first of all, I like the way you almost used a 19 handle to refer to something a while ago. That's my standard too. So that happens. In the pantheon of new managers who have helped pave that last mile, I think we owe some special thanks not only to the managers that you mentioned, but to Grayscale, which is still the largest Bitcoin product out there, and really was the first pioneering firm to kind of do things the right way and to see if a new firm that really believed in this asset class could remain important. And so firms like Grayscale, firms like Bitwise, who really kind of departed from the sort of purist crypto attitude of, if not your keys, not your tokens, and this is going to be instead of the financial system rather than in it. But who really saw and had vision for a bridge to traditional finance. I think those companies were really important. It is an important question if it's too late because Bitcoin is at 40,000 versus 3. Bitcoin will turn 15 next month, right? The first block was on January 3rd, 2009, and in those years, one thing that you can't manufacture right now, no matter how much money you have or no matter what kind of resources you have, you can't manufacture something that's 15 years old, right? So you have something which has not departed from its mission, which has kept its own kind of inflation and rarity standards, whose network effect has only strengthened. And after kind of realizing its own importance through dramatic price increases, has kind of not become less volatile, but stabilized in terms of relative to what it costs to produce and relative to its function in the macroeconomic environment. So I don't think at all it's too late to get involved in Bitcoin. If you're expecting a highly convex, without explanation rise of 100x or 1,000x, that may not be your asset. But if you're looking for something that has a distinct place in the macroeconomic conversation, that you saw predictably react to very intense Federal Reserve behavior in 2022, which you saw behave to a crisis in the lending markets, and saw behave in relation to all of the sort of misbehaviors of last year and those resolutions. You've seen something which has behaved fairly predictably and in fairly predictable cycles. And the reliance on those cycles to continue is exactly part of what the power is of having Bitcoin in particular among digital assets in a portfolio. So it might have been more fun to ride it from 1,000 to 40,000, but it will be just as useful, if not useful, in bigger risk quantities to improve the quality of most people's kind of major financial planning portfolios.
That's an interesting point of view, that way back when Bitcoin was $1,000, when I did tell people to buy it, I also said 1% allocation.
Right.
Because we didn't know what was going to happen. And I knew that if it blew up, 1% wouldn't hurt you. It wouldn't destroy your financial future. Today, now that the question of whether Bitcoin will survive or not seems to be gone, and the only issue now becomes how quick will it grow in broad engagement globally. That could argue, while the gains may, the party is over. We're not going to see a 40 million % increase again. That party's over. But on the other hand, it is more reasonable and reliable, and therefore could argue for a larger allocation than the 1% I used to advocate. So that means you can still generate outsized returns. You can still have an impactful benefit to the portfolio by recognizing that this party ain't over yet. Are you willing to offer a number, Andy, as to how high you think Bitcoin will go, either short or long term?
I'm willing to offer, I guess, an idea of how you would think about that number, because I'm not sitting on top of people's portfolios. But one thing that you're unlikely to get as a benefit with a 1% allocation is real diversification benefit, right? Basically, you're scraping 1% out of your real money and saying, I'm going to buy this thing which I will learn a certain amount about, but really it's either going to go to 1,000x or it's going to go to zero. That's you can't do too many of those things. So I would say that in looking at Bitcoin in particular, not Ether or not other digital assets, we're really focusing on Bitcoin, focusing on the sensitivities of other assets in your portfolio to things like interest rates, forward-looking inflation, quality or the sustainability of certain fiat currencies, and you need something to really come to the rescue in those scenario analyses, then you would size it according to that use case. You can also expect price appreciation in conjunction with those kind of events taking place. But I think you really can make a fairly strong case for a portfolio allocation where it's doing some portfolio weighting work, not just, if things go super well, this is going to be the best performing asset in my portfolio work.
Erik, what are your views? Yeah, I mean, we operate with a similar way of thinking about it. So, it's hard to say for any one particular client how Bitcoin should be sized in a portfolio. As a general rule of thumb, we're somewhere between 1 and 3, 1 and 5%. Really just depends on your stage of life, your risk tolerance, the other assets in your portfolio. But I think I want to go back quickly to your question about, is it too early or is it too late to get involved with Bitcoin and with crypto in general? But even just focusing specifically on Bitcoin, I feel like that mantra, I feel like I've missed the boat. I feel like I'm too late. I feel like every single crypto class has felt that. And to your point, are we going to get the 1,000x gains in Bitcoin now as we did a decade ago? And the answer is obviously no, because back in the day, you're being paid to take that incremental risk where you have no idea whether this asset's going to be around for the long term or not. And now you have a relative confidence that whether or not this asset becomes incredibly mainstream or not, that in 10 years, 20 years, I'm highly confident that Bitcoin's going to be around. So you're going to lose that incremental risk premium there, that adoption premium. What I will say is that, a mantra that I love in crypto is the most dangerous, the most bullish or dangerous thing about crypto is to be understood. And I can tell you from speaking with advisors, speaking with my family, the amount of people who understand the value proposition of Bitcoin, the fact that we're talking about a location agnostic, state agnostic, completely neutral asset that has a limited supply. That fact, even just that simple statement, is so foreign to especially US citizens, but to really most people, that I think that once, especially just in my conversations with people, like once you get that tidbit across to them, it's like they have a shift in their mindset completely, and they've seen the light. And so I think that we are still so early in terms of turning on that light switch for people. The market size is potentially huge for investing in Bitcoin. So I think that it would be absolutely premature to say, you know, you're too late now. I mean, of course, once again, you're not going to get the 1,000x gain, but I think that there's significant room for appreciation.
Yeah, I think to your point that the analogy might be Amazon. You know, we all had the chance to buy Amazon stock in the 90s. I don't know anybody who did, or anyone who held it through the
Bill Miller
dot-com bubble.
did, yeah, but
yeah, right, a little bit. Other than Jeff, I don't know anybody else.
right.
And those who did buy it probably sold it during the dot-com bubble. But today, it's safe to say that every stock investor owns Amazon, because it's inside every ETF there is. And the risk and the profit you're getting from it is nowhere near what you got over the last 20 years. So I think it's the same kind of thing. Is it too late? Depends on how you define late. But it's like real estate. Everybody always says that they wish they'd bought their house 20 years sooner than they bought it. And we'll probably say the same thing about Apple and Amazon, and we'll probably say the same thing about Bitcoin as well, that it's always too late if you're looking backwards, and the key is to look forward. There's another element that has historically been the case about Bitcoin. I want you to tell me whether you believe it remains so, and that is the non-correlation element. It's not merely the fact that the price is volatile or that the price rises over long periods, despite periodic declines like the last 2 years, but that its price movements are independent predominantly of the other financial markets. The prices generally don't move in sync with stocks, bonds, real estate, gold, oil, etc. There was a period during the pandemic where they certainly did move in sync with the NASDAQ. But aside from that relatively brief period over the last 14 years, the price have been largely non-correlated. And that's been a big driver for advisor attitude, because they love non-correlated assets. It helps build a diversified portfolio. Do you believe that that non-correlation is legitimate? And do you believe it'll be sustained going forward, Andy?
You know, it's an excellent point. It builds on my answer to the previous question about Bitcoin being able to do real portfolio duty, not just being something where, you know, you might expect outsized returns. The last couple of crypto cycles have given us time to really see how Bitcoin, in particular, reacts to different conditions. If you look at 2022, for example, and you have kind of a naive, you know, first glance look, Bitcoin might look like it behaved like equities, right? It went down. It had actually a similar path during the year, and you'd say, well, this is just another risk asset.
Right.
But when you peel back and say, hang on a second, let's think about things like inflation expectations and expectations for future real interest rates, then you see a much stronger relationship that you can extend just beyond 2022. And so I think that Bitcoin being non-correlated is always going to be interesting to any portfolio. Understanding the macro drivers and what you can expect to have happen can be even more meaningful to advisors who may want to change, who may want to have some kind of dynamic allocation. You know, Bitcoin's incredible performance this year is the best performing asset class on most of the charts that I see. You could ascribe that to kind of a release and improvement of the news cycle, or resolution of some of the criminal cases, or you know, the fact that lending conditions improved. But really, you know, a macro person who felt very strongly about the real rates argument would say, look, It's forward-looking, and it's looking at future inflation and future central bank response. And there you have it. So I think that can Bitcoin help in being functional in a portfolio? Absolutely. Does it move completely independently? No, it's a financial asset. It's a currency, and it's going to have certain macro properties. Can those macro properties be understood and made useful in an allocation, whether it's static or dynamic? We believe so. So we think that it's almost kind of better than just non-correlated, but actually kind of useful and has factors that can be used to help drive those decisions.
So everything that we've been describing so far has pointed toward stable, the elimination of the winter, moving into crypto spring, the increased willingness for people to talk about it, engage with it. The industry has made it easier than ever to participate. I'm assuming that therefore, Erik, this translates into greater adoption by investors, investment advisors, institutional players, et cetera. Does that greater adoption translate into higher prices?
So as it pertains to institutional adoption, that's been something that we've talked about for a long time in crypto. Ever since I've been in the space, I've been hearing the institutions are coming, the institutions are coming. And that's never actually quite played out to the extent that we would have hoped. And we're on the kind of eve here of a spot ETF, whether or not that happens, TBD. I think most people in the industry feel relatively optimistic that it will. I think it's going to be probably another 6 to 18 months, something in there, before you start to see more meaningful allocations among institutional investors to the space. That said, once you do get those incremental dollars coming into the space, I think it definitely has the potential to translate to higher prices. Crypto is a space that is fueled by liquidity. I guess to your point about correlation, we've actually seen correlations swing between highly correlated and uncorrelated depending on market cycle. Like most assets, it's a risk-on asset. It will tend to go towards a correlation of 1 in high stress environments, whether that's positive or negative volatility. Big drawdowns, you'll see Bitcoin follow suit. Risk to the upside, it'll also follow suit. But I think that what you're going to get here is that Bitcoin is going to the portfolio benefits that you're going to get from adding a potentially uncorrelated asset. What that is going to do to Sharpe ratios in institutional investment books is going to be enticing enough to get incremental dollars put into the asset.
So if you've got, this combination of factors that are occurring right now, and as you've noted, it's going to take time. I think when those Bitcoin ETFs come out, and I'm in the when camp rather than the if camp, when they finally do come available, I think there's going to be a disappointment by many that those ETFs aren't getting flooded with new assets on day one. And I think that's because people are being a little unrealistic about how long it takes advisors and institutions to engage. It's not, you've got to have the due diligence team do what they do. You've got to have the investment committee figure out which product to provide. You've got to train the advisors. You've got to discuss it with clients. This stuff takes time. So it's not going to happen in days and weeks. It's going to happen, like you said, over months and years before we really see a lot of asset flowing from all sectors of the financial marketplace into Bitcoin. What does that mean for the price of Bitcoin? Should investment advisors wait to engage, or do we engage now? It's kind of like the conversation of 10 years ago. Should I buy Bitcoin when it's $1,000 or wait for it to be 50,000? Here it is at 40,000. Do I buy it now or wait for it to become 80,000? I guess what I'm saying, what's the trend? What does all this talk about? And Andy, you might even want to raise the issue of the Bitcoin trend indicator that CoinDesk provides.
Everything that you just mentioned it went into our thinking just about a year ago when Bitcoin was at 15,000, when we realized that advisors not only would have to take the risk of doing all this work to prepare to offer digital assets as an allocation to their clients, but they also had to ask their clients, and their clients had to say yes, right? So it's just like when I put vegetables on the table with my children, you can bring the vegetables to them, but there has to be adoption, right? Again, the last mile has to go all the way to the front door. And we felt, and when we interviewed people and we interviewed ETF issuers and advisors, the feeling was that that people were still nervous. And I think people are, the fact that we've accelerated in price may make them a little less nervous, but not, not a state change of complete, disappearance of anxiety. So we developed a trend indicator for Bitcoin, and maybe we can show that slide to show what it kind of looks like. And all it is doing is saying, look, we're going to look at the price trend in Bitcoin. We're going to go back to different look back periods and see if the price of Bitcoin is trending higher or lower. And this presents an interesting opportunity for managers to say, look, well, if I create a portfolio that's going to really increase allocation to Bitcoin when there's a positive trend, but allocate more away from Bitcoin into a safer asset like cash or cash plus some yield when the trend is negative, I can sort of meet my client halfway when it comes to, look, I want to be involved with this thing, but this thing's very volatile and can change on big news and can change on things that I don't track every day, about people that I don't track every day. And that can lead to prolonged periods of pain that might be either coincident, as Erik pointed out, with other financial stress or even independent of other financial stress. So I need someone to hold my hand here and get me in and out to make sure I can participate, but not be up all night worrying about it. And by the way, advisor calling you and asking you what the heck is going on. So just to quickly go over what this chart shows, our indicator, which we publish every day on our website, coindeskmarkets.com, really calculates this indicator every day. And you can see the indicator is pointing towards a higher allocation to Bitcoin when the line is green, and pointing towards an allocation to cash when the line is red. So Bitcoin happens to observe this time series momentum, this trend behavior really strongly. So if you have a well-calibrated signal, you can, over market cycles, do a very good job of reducing the risk of a Bitcoin holding dynamic strategy, while still giving access to those upside periods when the token really does well. As you can see in the last couple of months, I think that our trend signal went positive sort of second week of October and has been hanging on all the way from below 30,000. So this we feel is a way for advisors to get clients interested in a way when they know that they have an opportunity to reduce some of the volatility of that holding, but still get used to the feeling of having Bitcoin in their portfolio.
So this clearly shows that we're currently in a significant uptrend, and the question is whether, how long will that go and how high will that go, which is what, of course, everybody always wants to be paying attention to. I think that the really interesting element of this is that we really want to know whether or not the conversation is limited to Bitcoin. I'm getting several questions from folks here today who are asking, because you've talked a lot. In fact, you made a particular point, Andy, earlier, saying you were specifically talking about Bitcoin, not Ethereum.
Right.
Broaden the conversation. Is this a Bitcoin only phenomenon, or, talk about Bitcoin versus Ethereum in particular, and more broadly other digital assets?
So maybe I'll just, we cover 500 tokens, and Bitcoin is always going to be special in that conversation because it's the first, it's the biggest, it's the digital currency which is the purest of purpose and the most widely adopted. It is in almost every market going to be the first token that makes its way into a regulated instrument and finds its way into someone's brokerage account or some kind of traditional finance account. It has scale. It has tenure. It has the biggest network effect, and so it kind of deserves its own place as an individual macroeconomic piece of market structure. Ethereum, or its token Ether, the second biggest, about half as big as Bitcoin in terms of market capitalization, really is a very, very different animal. It represents the future of the technology around smart contract platforms. It represents almost a commodity value to the kind of currency or commodity that you need to spend to drive those contracts. It's a platform as much as it is an individual token. So its behavior and its characteristics are much more around growth and use and expansion of Web3 technology than something that's more linked to a macroeconomic kind of model. Ether also, and Ethereum also, is a proof of stake token, which means that its consensus mechanism is based on validators staking tokens to guarantee that they're going to behave properly in making sure that the network is secure, rather than proof of work like Bitcoin, which means that there's an inherent, almost risk-free yield that's governed by a monetary policy. We actually have a product that calculates that rate called Caesar. And so you have in Ether this fantastically complex thing, which is based partly on growth, based partly on an internal monetary policy, has access to a yield, has some high correlation to Bitcoin, but not as high as it used to be, and really can serve kind of an adjacent but different portfolio purpose. As you go down from there into the altcoin world, you have a wide variety of things. The ones that are larger right now, the larger tokens tend to be the ones that have been around longer, which means that their use cases, their communities, their raison d'etre have been established and understood. There aren't too many. One of the, I guess, benefits of having kind of a washout like we did in 2022 is that the things that are regrowing are the things that have the best chance of health and the best chance of comprehension, right? The most of the truly frivolous things have kind of been washed out of the system and probably will have a hard time finding themselves back onto the main stage of the largest cap tokens again. So,
but not all of them. Dogecoin still exists.
Well, we think a lot about Dogecoin, and I think Dogecoin's been around quite a long time. It is accepted as currency in a lot of different contexts. It has a very strong community, and I think if you can pay for something, and if it's good currency in a business that you otherwise might use dollars, it has maybe transcended its early frivolousness and transformed into something which is useful. It's a top 10 token. It's many, many billions of dollars of market capitalization. It trades well. I think people have at least some investors have grown out of that adoption of Dogecoin in a in the way in which it came to be. So I think we have to look at tokens, some of which started out being very I guess, noble in purpose and have taken on a more fringy sort of popularity, and others started off in a fairly frivolous way and have grown into something kind of useful. So I think we have to be open-minded about those changes that take place. But as you say, if it's something that sticks out like that in a way where you would expect it to behave differently, then that increases the opportunity for diversification as you look at broader portfolios of digital assets.
Does CoinDesk offer a trend indicator for Ethereum the way it does for Bitcoin?
We do, and the funny thing is, we have a very principled. Our head of research, Todd Groff, is a very principled financial engineer and quantitative analyst, and very much like, hey, I did this research, and this is in sample versus out of sample, and we were very careful about not wanting to show fantastic historical results. So we tried. We had reached the right trend indicator methodology, which is on our website. You can look at it and reconstruct it yourself if you like. And then we just took the same code and put it on the Ethereum time series, and it worked even better, right? So it was just an amazingly surprising result. Both those tokens, because of their network effect, because we're in this kind of, and as Erik said earlier, we're in an adoption cycle that's nowhere near reaching maturity. You're going to have this kind of strength of time series momentum that makes it a very powerful effect to decide when or when not to feel really good about those. So we publish that trend indicator on our website as well. And I think that those until the market really changes its nature, both Bitcoin and Ether, and to a lesser extent other tokens, will continue to observe those trend properties.
So Erik, how does Global X use these trend indicators that CoinDesk has created?
Yeah, it's a great question. So currently we've partnered with Andy and his team on a Bitcoin trend indicator product. It's currently offered in an SMA format. And what we are able to do is to use the daily signal that CoinDesk produces about the relative strength of the Bitcoin trend, and then to allocate a portfolio depending on that signal. So there's one of 5 signals ranging from Bitcoin being in a significant downtrend to neutral, all the way up to Bitcoin being in a significant uptrend. Depending on that signal, which is illustrated by those various colors on the graph that you pulled up earlier, we will allocate accordingly to a portfolio that's divided between Bitcoin and cash. So in a strong uptrend, when we have all of the different data points that we're looking at, there's just various exponential moving averages. When all of those are pointing to bullish market activity, the SMA is going to be invested 100% in Bitcoin and 0% in cash. And as you kind of incrementally go down the bullish to bearish spectrum, that allocation is going to become more heavily allocated to cash and less heavily allocated to Bitcoin, with the idea being that what we're trying to provide to investors is an efficient vehicle that's going to allow them to capture a lot of that upside momentum, provide exposure to Bitcoin when you actually want to be exposed to it, when it's in the news for breaking all-time record highs in prices, and to, as soon as possible, start to pair losses as that price of momentum reverses and you start to fall to the downside. So what you're doing, you're sacrificing what is usually just a very small amount of upside for significant downside protection, just based on varying that portfolio allocation and SMA on a daily basis.
So it can be 100% in Bitcoin. Is there ever an occasion where it can be 100% in cash?
Yep, absolutely. And that's one of the things that I think is probably even more important about this product is it's going to be something that's going to allow an advisor to go to a client and say, I have part of your portfolio in this SMA product. It'll get you back exposed to Bitcoin when the momentum changes. But for right now, if FTX is happening or Three Arrows Capital is unwinding and Bitcoin's in this kind of nuclear downtrend, the advisor is going to be able to go to the client and say, don't worry, you can sleep. We're 100% cash right now. So of course you're going to get some of that downside, but you're not going to.
That sounds really cool, because as Andy was explaining the trend signal, I'm thinking, and he said CoinDesk updates it every day. I'm thinking to myself, oh my God, I got to look at this every single day and I've got to act on it with a trading behavior. And I got better things to do for a position that is only low single digits anyway in the portfolio. And I'm thinking, how does an advisor effectively deploy this? But you just answered the question. All you got to do is put the money into the SMA, which is simple and easy as buying an ETF. And it's from the advisor's perspective, set it and forget it and let Global X do all the work.
So I think that's something, crypto often cases is so similar to the world of traditional finance. We tend to try to disregard that, but it's actually true. Crypto is it's like traditional finance on steroids. So any kind of like emotional reaction you have to trading in the traditional financial world, it's going to be like times 10 in crypto, right? Because the price movements are so much faster. They're so much more significant in magnitude. And so the perspective that we're coming at this from is we want to try to remove that emotional reaction to changes in prices as best we can. Because the last thing that you want to do when you're investing in kind of this nascent technology is to let your emotions get the best of you, sell at the absolute worst time, and then fail to pick it back up on the upside. By automating the process, we can effectively, dampen some of that emotional response and let the advisor be able to be comfortable with the fact that a lot of that risk management is happening on the back end. So, for something that's going to be 1% of your portfolio, why would you spend 99% of your time worrying about it? That's
no, it makes an awful lot of sense to me. There are two particular questions that we haven't gotten to, or two topics that in our closing several minutes, I want to make sure we do. The first one you mentioned earlier, Andy, Larry Fink, or I think Eric, you did, that Larry Fink has been very famously bullish on Bitcoin broadly. On the opposite end, his evil twin is Jamie Dimon, who just said last week, if he were the government, he would ban it. So why is Jamie, there's the question we're getting from Thomas, who's watching us today. Why is Jamie Dimon still saying that he so hates Bitcoin? Andy?
Oof. You know, let's see. Do we have a firm view on this topic? I can say that what I really loved about JP Morgan, in addition to having many friends who work there, is the fact that their research coverage has started to include some really nuanced parts of talking about the digital asset market. Not only, you know, famously, you have to cover equities like Coinbase and things like that, or Marathon or other equities. You sort of have to look at the prices of digital assets to get a sense of what's going to happen to the earnings of those companies. But I even have seen things even about the Ethereum staking rate show up in macro reports by JP Morgan macro research people. So I think that the work's being done and funded to understand and appreciate the market. Of course, also JP Morgan and most other banks are working on private or public blockchain projects. SocGen recently issued its first stablecoin, and blockchain-based fixed income instruments have been released. You know, it's
JPM
funny.
coin is moving $1 billion a day cross border.
Right.
So
you know, it's important for especially advisors. You know, a big question is like, why are banks even just not doing things more assertively? You know, right now the big banking question is how much do they have to reserve for every Bitcoin that they hold? And right now that amount that the regulations require that they reserve is a punitive amount. It's really a kind of banks wait and see until this matures a little bit more, and then we'll create reserve regulations that are more favorable to you entering the space. So banks are in a very difficult position where they're very eager. Like, you can't say a bank isn't going to appreciate a new asset class, right? A lot of parts of banking have become let's say mature, and something new where people are excited and where there is diversification benefit is certainly going to be something that people want to investigate more. Banks have just been hampered by their ability not to have things sit on their balance sheet too much. And I think that leads to some bankers kind of having mixed views. And I think whatever the dynamics were in the room when Mr. Dimon made his comments, I'll leave that to whatever his short and medium term goals were. He's an important person who I admire deeply. But I think that well, let's just wait and see what JP Morgan does in the next 10 years.
In other words, you think Jamie Dimon might be eating crow one day?
I think oh gosh, no, I wish him the best. Listen,
or is he going to become
important.
the next Treasury Secretary and ban Bitcoin? So we'll have to wait and see.
Let's just say he might become the next Treasury Secretary and adopt Bitcoin and just have a change of heart, right?
Okay, I'll buy that. And then the other big elephant in the room, we've been talking all about dancing around a little bit, the coming ETFs, the spot Bitcoin ETFs that everybody's anxiously waiting for. What we haven't talked about is the Bitcoin halving. So Eric, first explain to make sure everybody understands what that is, and then what you think its impact may be on the price of Bitcoin in 6 months.
Yeah, so the Bitcoin halving is probably one of the biggest catalysts that we're keeping our eye on for Bitcoin in the next 6 months, as you mentioned. This is an event that happens about every 4 years in the Bitcoin world. It's currently targeted for about April of 2024, and it occurs after a certain amount of blocks have been mined in the network. So it's not up to any decision maker about when it happens. It happens after 110,000 blocks have been mined, and that falls usually around every 4 years. And what's so significant about it is that new issuance of Bitcoin happens via the process of mining. So as we move incrementally closer to that number 21 million Bitcoin, the final Bitcoin, mining is eventually going to cease to exist. So the halving is a really important part of that process. It is the It is an instance in time where the issuance rate of Bitcoin that happens in each block is cut in half. So currently, there's every 10 minutes or so, there's a block of the Bitcoin network that's mined effectively. All the transactions are aggregated and kind of codified into the network forever. And as a reward for mining the block, for validating the transactions on that block, a miner earns a reward of 6.25 Bitcoin as a compensation for burning a lot of electricity on the back end to verify the transaction. At the halving, that 6.25 is going to change to 3.125. So effectively, you are, as the name suggests, you're cutting in half the amount of issuance that's happening every time a block is mined. And that process, it's kind of like this asymptotic process, but it's going to get us incrementally closer to 21 million Bitcoins mined, and eventually it will cease. And what this effectively is a supply shock to Bitcoin. Much like other commodities, price is driven a lot by the point where demand and supply meet. So at this one point in time, demand for Bitcoin generally, all else equal, remains the same, and the supply curve shifts significantly to the left. And as a result, what you have is you tend to have relatively violent price reactions. It doesn't happen necessarily immediately, as you might expect, because a lot of the times it is Bitcoin miners that are the ones selling new Bitcoin into the market in order to raise cash and be able to pay real world bills using dollars instead of Bitcoin, because I don't think many electricity companies take Bitcoin as payment. But so it takes about 6 months to a year for this to be priced in fully. But when it happens, it's relatively violent, or has been for the past 3 halving cycles. So we anticipate a similar reaction this time around. Now, of course, as you cut these rewards in half each time, it becomes less and less important to the overall circulating supply of Bitcoin. So you're not going to get as strong of a price shift up, because the supply shock just isn't as big in relative terms of the supply. But regardless, we expect this event to have a significant impact on price moving forward, to the likely probably bring Bitcoin more to that like 50 to 100K range over the next year or so.
And Andy, you're nodding your head in agreement.
That's been the process so far, and I think you always want to be careful. I'm sure Erik wisely kind of conditioned his remarks that you do have a change in the supply demand shift. You do have historical cases. It's not a happy time for the miners who are suddenly earning half as much as they used to earn, and their economics have to react to that. But look, I've been in finance 25 years, and the only thing that can really create a bad situation is a surprise, right? And I think one of the beautiful things about Bitcoin is, at least in terms of when the halvings take place, there really isn't any kind of possibility of surprise. So will the price react? The prices react violently and positively. It's a violent and negative reaction seems unlikely, since everybody knows exactly what's going to happen.
So this has been a fascinating conversation. There's a lot of tailwind behind us now for the first time in several years. We've got the price of Bitcoin at the highest in all year long, with a 150% gain year to date. We've got the ETFs that everybody is hoping are coming soon. We've got the Bitcoin halving in 6 months. We have Wall Street engagement like never before, and real professional financial analysis and research, as evidenced by the Bitcoin trend indicator from CoinDesk, which is being deployed in an SMA by Global X. So it's never been easier to engage, that you can integrate easily into your practice management. And I encourage you to take a look at this very closely. And the sooner, I think, the better off you and your clients, your entire practice management is going to be. So Andy Baehr and Erik Anderson, thank you so much for joining us on this program. I want to make sure that you're aware of other events that we have coming up here at DAC FP. March 11 and 12 is our brand new Wealth Management Convergence, which is a 2.5-day event that covers not just crypto, but all the key investment topics and strategies that advisors need to focus on today. You can learn all about it at dacfp.com, or just take a photo shot of that QR code. And our Big Vision event, the longest running event. This is our 7th annual. It's the oldest and longest running, biggest advisor-only crypto event. It's going to be June 2 to 4 in Austin, specifically crypto, and you'll get the latest news and the actionable ideas to help you integrate crypto into your practice. And I encourage you to get your CBDA and become certified in blockchain and digital assets. Demonstrate to your clients that you're staying state of the art with this research and analysis, that you are fluent in crypto. It's an online self-study course with a world-class faculty. Half the course is on the tech. The other half is all on practice management. And there are 5 different tracks, depending whether you're an advisor, a back office professional in the crypto field, an investor, or outside the US, because we've got folks from 37 countries who have obtained their CBDA designation. I encourage you to read my #1 Amazon bestseller, The Truth About Your Future, and to listen to my daily podcast. And real importantly, coming up as soon as the SEC approves these ETFs, I'm going to be launching a special podcast series introducing you to the new spot Bitcoin ETFs. You can sign up right now at my podcast site, thetruthaboutyourfuture.com. This way we'll let you know as soon as those podcasts are going to air when the ETFs get approved, so that you are getting all the info you need directly from the ETF providers. And in the meantime, you can download for free my white paper, Everything You Need to Know About the Spot Bitcoin ETFs, so that you are prepared and your clients are prepared. And if you have any questions we weren't able to cover today, you're welcome to reach out to us. I'm easy to reach, and here's how you can reach me. We'll also encourage you to contact CoinDesk and Global X ETFs at globalxetfs.com. I'm Ric Edelman. Thanks so much for joining me on the program today. Have a happy holiday. We'll see you next time.